I going to do?
If you are earning what you always believed would be enough, why does it not feel like enough? Why does someone earning $60, $70, $80, $90,000 a year still find themselves checking their balance before a grocery run, still lying awake running the numbers, still feeling the particular background anxiety of someone who is one unexpected bill away from real trouble? The standard answer, the one that most personal finance content quietly implies, is that you are doing something wrong, that you are spending too much on the wrong things, that you lack discipline, that your priorities are misaligned, that somewhere in your daily choices there is a flaw of character that is holding your financial life back. That answer is wrong. It is not just incomplete. It is actively misleading. And believing it keeps most people looking for the solution in entirely the wrong place. Nina is 34 years old and works as a senior account manager at a logistics company in Chicago. She earns $81,000 a year, which is more than she ever imagined earning when she graduated 11 years ago, more than her parents ever earned simultaneously, and more than almost everyone she grew up with. By any external measure, she is financially successful. She has a good job, a decent apartment in a neighborhood she likes, a reliable car, and a social life she enjoys. What she does not have is any real financial breathing room. Her savings account holds between $400 and $1,200 at any given point in the month, depending on where she is in her pay cycle. She has $7,400 on a credit card that she has been meaning to pay down for 2 years, but has not meaningfully reduced it. She has approximately $18,000, which she knows is not where it should be at her age, but has not done anything about. Every month she tells herself that next month will be different. Next month she will finally get ahead. Next month arrives. It is not different. She has told no one about any of this because, from the outside, her finances look fine. She earns good money. The problem is invisible, and it is driving her quietly insane. Nina is not an unusual case. She is, in fact, a remarkably common one. The specific details change from person to person, but the underlying structure is almost identical across an enormous number of financially capable, professionally successful people. An income that should be sufficient, a financial reality that is not, and no clear explanation for the gap between the two. What I am going to do in this video is name the 5 specific mechanisms that produce Nina's situation, explain exactly how each one works, and give you a way to diagnose which ones are operating in your own financial life right now. The reason most people cannot fix this problem is not a lack of effort or lack of discipline. It is that they have never had a name for what they are dealing with. The first reason is one we touched on in earlier videos in this series, but it is worth going deeper on because understanding it properly changes how you think about salary growth entirely. When your income increases, your brain does not register the increase as additional money available for savings or investments. It registers it as a new baseline. This is not a metaphor. It is a measurable neurological response. The human brain is wired to adapt to new levels of consumption remarkably quickly and to defend that adapted level as the minimum acceptable standard of living. Psychologists call this hedonic adaptation, and it operates automatically and almost completely below the level of conscious decision-making. You get a raise. Within 3 to 6 months, the life you are now living feels like the life you need to sustain, not a step up from something more modest. The raise disappears into the upgraded baseline without a trace, and the financial margin you thought the raise would create never materializes. The financial mistake to avoid here is treating a salary increase as an opportunity to upgrade your life before you have deliberately decided what to do with the additional income. Every time your salary grows, and you allow your spending to grow with it automatically, you are paying what I call the invisible raise tax. This is a levy on every income increase that goes directly to lifestyle maintenance rather than to wealth building. The people who seem to always have money are not necessarily earning more than everyone around them. They are disproportionately the people who decided, at some point, to stop paying the invisible raise tax by directing every meaningful income increase toward a specific financial goal before lifestyle had any chance to consume it. When Nina got her last raise of $8,500 a year, her rent increased 3 months later, and she bought a better car. The raise was gone before she had processed it. She did not make that decision consciously. The invisible raise tax collected itself. The second reason is less discussed than lifestyle inflation and considerably more uncomfortable to look at directly. It is called identity spending, and it operates through a mechanism most people have never examined because it feels like something other than a financial decision. Identity spending is the money you spend to signal, maintain, and defend the version of yourself that you want the world to see and that you need to believe yourself. The apartment in the neighborhood that says something, the car that suggests success, the restaurants, the clothes, and the holidays that position you in a social context. The professional wardrobe that costs more than you would spend if your salary were half what it is now. None of these feels like a discretionary choice when you are inside them. They feel like requirements. They feel like the minimum cost of being the person you have become or are trying to become. And that feeling of requirement is precisely what makes identity spending so financially destructive, because it places an entire category of spending beyond the reach of ordinary financial scrutiny. The way to identify identity spending in your own financial life is to ask, for each significant recurring expense, one simple question. If my income dropped by 30% tomorrow, would I continue this? If the honest answer is no, that expense is partially or entirely identity spending rather than genuine need. This is not a moral judgment. Identity spending is a completely understandable human behavior, rooted in deep social instincts about belonging and status. But it is one of the most significant reasons that people earning good money still feel financially constrained, because it silently caps the percentage of income that is actually available for wealth building, regardless of how high the income climbs. How rich people think about money is often characterized as a difference in values or priorities, but much of it is simply a different relationship with identity spending. It is a willingness to let the financial reality be invisible while allowing the visible signals to remain modest, rather than the reverse. The third reason is the one that generates the most genuine injustice, because it has nothing to do with behavior, values, or discipline. It is about the absence of information that most people were simply never given. Financial literacy basics are not taught in schools in any meaningful way in most countries. The average person leaves formal education knowing how to solve quadratic equations and recite historical dates, and knowing almost nothing about how tax-advantaged retirement accounts work, how compound interest operates on debt versus on investments, how to evaluate an insurance policy, how to read a credit report, or how to structure their spending in a way that actually builds wealth over time. This is the financial fluency gap, and it costs people who earn good money an enormous amount of money every year, not through bad decisions but through absent decisions. These are things they could be doing that they simply do not know exist. Consider the concrete financial impact of the fluency gap on a single person. Someone who does not know how their 401k employer match works, and therefore does not contribute enough to capture it, is leaving money on the table every single pay period. Someone who does not understand how credit utilization affects their credit score is paying higher interest rates on every loan they take for years longer than necessary. Someone who does not know that a health savings account exists is missing one of the most tax-efficient savings vehicles available to them. None of these is a failure of character. They are failures of information. And the financial impact of information failure on someone earning a good salary compounds negatively over years and decades, in exactly the same way that good financial decisions compound positively. The fluency gap is not a reason to feel bad about your current situation. It is a reason to take financial education as seriously as any other professional skill you have invested in developing. The fourth reason is one that people who are financially stressed and professionally successful rarely consider, because it feels like the opposite of a problem. It is busyness. Specifically, it is a life so full of professional, social, and family demands that the kind of sustained, focused attention that building a genuinely strong financial position requires simply never gets scheduled. Money management is often framed as a habit, something you do automatically in the background of your life, like brushing your teeth. But actually building wealth requires something different from habit maintenance. It requires periodic, deep, deliberate attention, reviewing your financial position, making decisions about investments, optimizing your debt structure, understanding how your income is being taxed and whether there are legal ways to reduce that burden, and adjusting your financial plan when your circumstances change. These are not 15-minute tasks. They are the kind of thinking that requires a clear hour or two without distraction, 2 or 3 times a year at minimum. Most people who earn good money and still feel financially stuck have simply never given their finances that kind of sustained attention. Not because they do not care, Because they are genuinely, legitimately busy with a life that makes real demands on their time and energy. The result is a financial life that runs on autopilot. Direct debits going out, paychecks coming in, the credit card balance drifting upward, the investment account sitting unchanged for 18 months, the insurance policy never reviewed since it was signed, the bank account earning almost no interest when a better option exists 2 clicks away. None of this is catastrophic in isolation. Together, across years, it represents the cost of financial autopilot on someone who had the income to build real wealth and simply never gave it the attention it needed. The fifth reason is the one that makes the other 4 extremely difficult to address even after someone has identified them, and it is the mechanism that most directly explains why financial anxiety does not correlate with income the way most people expect it to. It is the normalization of debt as a permanent feature of adult financial life. In a culture where financing a car is the default rather than the exception, where credit card balances are carried by the majority of cardholders, where buy now, pay later services have been normalized for purchases as small as a $30 item of clothing, and where student loan payments are an assumed fixture of early and mid-career life, most people reach their 30s carrying a monthly debt service cost that would shock them if they calculated it as a single annual figure. The financial impact of normalized debt is not simply the interest cost, although that is significant. It is the monthly payment infrastructure that sits on top of your income before you can make any deliberate financial decision at all. Every month, before you have chosen how to spend a single discretionary dollar, a collection of creditors has already claimed a portion of your paycheck. The money anxiety that comes from carrying normalized debt is qualitatively different from the anxiety that comes from other kinds of financial stress, and it is worth naming that difference clearly. When your monthly debt obligations are high enough to constrain your financial choices, you feel the constraint every time you make a decision, every time you consider saving something, every time you think about an opportunity, every time you do the mental calculation of whether you can afford something that matters to you, the constraint is there. That constraint operates like a ceiling that moves with your income but never quite goes away. People who consistently carry significant monthly debt service loads often describe their relationship with money as one of permanent mild panic, regardless of how their salary has grown, because the salary and the debt obligations have grown together, maintaining a gap that never widens enough to produce real breathing room. Recognizing normalized debt as infrastructure is the first step toward treating it as something to be systematically dismantled rather than a permanent feature of adult financial life. Before the closing story, I want to give you a way to apply what we just covered to your own financial situation. Because understanding these 5 reasons in the abstract is useful, but naming which ones are actually operating in your life is where the real value is. So here is how to do a quick diagnostic. For each of the 5 reasons, ask yourself one honest question and sit with the answer. For the invisible raise tax, has every meaningful salary increase you have received in the last 5 years been followed within 6 months by a proportional increase in your monthly expenses? For identity spending, are there recurring expenses in your life that you would quietly drop if your income fell significantly, but that feel non-negotiable at your current income level? For the financial fluency gap, are there financial tools, accounts, or strategies you know exist but have never implemented because you do not fully understand how they work? For the wrong kind of busy, when did you last spend more than an hour doing nothing but reviewing your financial position and making deliberate decisions about it? And for normalized debt as infrastructure, what percentage of your monthly take-home income is committed to debt payments before you make any discretionary financial decision? Most people going through this diagnostic for the first time find that at least 3 of the 5 reasons are present in their financial life in a meaningful way, often all 5 to varying degrees. That is not a reason for discouragement. It is precisely the information needed to stop looking for the solution in the wrong place and start addressing the actual mechanisms that are producing the outcome you want to change. The money management tips that work are the ones that target the specific mechanism causing the problem. Generic advice about spending less and saving more fails most people, not because the advice is wrong, but because it addresses the symptom rather than the cause. Derek is 38 years old. He earns $94,000 a year as a project director at an engineering firm in Austin, Texas, and he has been earning over $70,000 for the last 6 years. He has $31,000 in credit card debt spread across 2 cards, $22,000 left on a car loan, and $47,000 in his 401k, which he knows is significantly below where it should be for someone his age. His savings account rarely exceeds $2,000. He feels, most of the time, like someone who is treading water in a pool that is just barely within his depth. All 5 reasons are operating in his financial life simultaneously. Every raise he has received in the last 6 years has been followed within months by a lifestyle adjustment that absorbed it. That is the invisible raise tax. He drives a car and lives in an apartment that positions him as the successful professional he considers himself to be, and cutting either significantly would feel like a statement about who he is, rather than just a financial decision. That is identity spending. He has never once opened the investment options inside his 401k, and has been in the default fund since he was enrolled. That is the financial fluency gap. He reviews his finances briefly and anxiously, rather than deliberately and periodically, mostly when something goes wrong. That is the wrong kind of busy. And his combined monthly debt service is $2,340, which arrives before he has made a single discretionary decision about how to spend the remainder of his paycheck. That is normalized debt as infrastructure. Derek is not irresponsible. He is not reckless. He is not bad with money. He is operating inside 5 interlocking mechanisms that none of his professional training, none of his education, and none of the standard financial content he has consumed has ever named or explained. When he finally identified all 5 of them, sitting down with a notepad on a Sunday afternoon and doing exactly the diagnostic described in the previous section, he described the experience as both genuinely unsettling and the first time in 10 years that his financial situation had made complete sense to him. Not comfortable, not fixed, but explicable. And explicable means addressable. He is currently 2 years into a structured plan that directs every future salary increase away from lifestyle before lifestyle can claim it, which is reducing his monthly debt service by $400 per quarter. And that has his 401k finally in an appropriate allocation for his age and timeline. His savings account crossed $10,000 for the first time last month. He did not celebrate extravagantly. He just felt, quietly and for the first time in a long time, like someone who is moving in the right direction, rather than running to stand still. What to do this week? Before the recap, I want to give you one concrete thing to do this week. Not a system to implement or a set of rules to follow. Just one thing that will give you more useful information about your financial position than most people have. Calculate your monthly debt service as a percentage of your take-home income. Add up every minimum debt payment leaving your account every month. The credit card minimums, the car loan payment, the student loan payment, any buy now, pay later commitments. Divide the total by your monthly take-home pay and multiply by 100. If that number is below 15%, you have meaningful financial flexibility. If it is between 15 and 30%, you are operating in a constrained zone where wealth building requires deliberate strategy. If it is above 30%, your monthly debt infrastructure is the primary reason your income does not translate into financial stability, regardless of how it grows. And addressing that infrastructure specifically, rather than trying to budget your way to a solution, is where your energy should go. That one number, calculated honestly, tells you more about the real shape of your financial situation than almost any other single figure. Write it down. We are going to build on it in the next few videos. Let's have a recap of all the points. 5 reasons why people who earn good money still feel broke every month. The invisible raise tax, which collects every income increase for lifestyle maintenance before savings can claim any of it. Identity spending, which places a significant category of expenses beyond normal financial scrutiny by attaching them to professional and social identity. The financial fluency gap, which costs people money not through bad decisions but through absent decisions. The wrong kind of busy, which means the sustained deliberate attention that wealth building requires, never gets scheduled among the legitimate demands of a full professional and personal life. And normalized debt as infrastructure, which creates a fixed monthly obligation that constrains every financial decision before it can be made, regardless of how income grows. These are not character flaws. They are mechanisms. Mechanisms can be identified, understood, and systematically dismantled. That is what the rest of this series is about. The next video covers the 5 specific money habits that consistently show up in the financial lives of people who build real wealth on ordinary incomes. Not the dramatic moves. Not the investment strategies that require significant capital. The quiet, unglamorous daily and monthly habits that produce a fundamentally different financial trajectory over 5 and 10-year periods. That video is already on this channel, and it picks up directly from where this one ends. Subscribe to Capital Notes if something in this video resonated. Every video in this series is designed to build on the last, so the further into the sequence you go, the more useful each individual video becomes. See you in the next one.